Hello, thanks for tuning in. I'm Dami Coker for Scientific Beta. As a little background, Scientific Beta is a venture that was launched in 2012 by the EDEC Risk Institute, part of one of the leading business schools in Europe. Scientific Beta is a dedicated index activity that specializes in smart beta indices. We offer market solutions that are backed by academic rigor and research. So recently, Scientific Beta partnered with CoreShares, a leading passive investment manager in South Africa that has a particular focus on smart beta. CoreShares is somewhat of an innovator in the local passive investment space, and through this partnership, the aim was to launch a fund based on Scientific Beta's multi-factor methodology, but that is applied to the local market of CoreShares. So today we're going to be looking at the topic of smart beta and introduce viewers to this fast expanding area in the world of finance. And joining me today to help shed some light on this topic is Eric Shabini. Hi, Eric.
Hi, Dami.
And Eric is the Global Research and Investment Solutions Director at Scientific Beta. Okay, Eric, so thanks for coming to speak with me today. So let's get straight to it. The term smart beta covers a wide range of definitions. Sometimes we call it strategic beta, style beta, even factor investing. But what do you define as smart beta?
Okay, so smart beta is basically, it's an index strategy. So therefore, it's entirely rules-driven and it's 100% transparent. Now, there are two elements of smart beta that are very important, or two elements that smart beta strategies try to capture. So smart beta provides the investor with access to risk factors in addition to the market. So in equities, in addition to providing exposure to the overall market, it also provides exposure to additional risk factors. Now, these risk factors are well known to be rewarded over the long term. So in this way, smart beta strategies provide higher risk-adjusted returns over the long term when compared to just investing in a cap-weighted index. So that's the first element of smart beta. It's essentially the beta component. But there is also another element to smart beta. Smart beta strategies also improve the level of diversification of an index, particularly compared to a cap-weighted index. Cap-weighted indices tend to be highly concentrated. By having an index that is better diversified, it leads to less extreme risks in the short term, and interestingly, over the long term, it also provides higher risk-adjusted returns. So smart beta is about those two elements. It's being exposed to well-rewarded factors. It's also about diversification, and Scientific Beta uses both of those elements to construct its multi-factor and single-factor indexes. Now, institutional investors and academics have known about these well-rewarded risk factors for a very long time, but it's only recently that these strategies have become available as indices. Now, since they're available as an index and they are fully transparent, it means that smart beta strategies are also less costly to implement. They're fully transparent. Indices are a much more cost-effective way to get exposure to these risk factors, and yet they provide consistently good risk-adjusted returns that have really only been available through very good active managers. So that really is a brief overview of what smart beta is. Okay,
thanks. So now that we have an overview of smart beta, how do you differentiate between factor investing and thematic investing? Factor investing being, strategies that high dividend strategies or low volatility momentum, and thematic investing being such as SRI, ESG investing, Islamic finance. How do you differentiate between those two?
Okay, so let's start off with thematic investing. So thematic investing simply groups stocks together that have a common predefined characteristic. You mentioned Islamic finance. The common characteristic could be ESG, environmental, social, and governance criteria, or it could be even something like stocks that are exposed to the cyber economy. Now, these themes exist because the investor believes that these themes will do well. So basically, these themes, or a thematic investment, is basically all about an investor taking a view over what they believe will do well in the future. Now, factor investing is different. In contrast, factor investing is all about investing in what we call priced risk factors. So these priced risk factors are priced by the market and are backed by an economic rationale that explains why there is an additional reward to holding these risks over the long term. Now, the main difference then is that the investor doesn't need to take a view in terms of what will perform well and what won't perform well. These risk factors provide good risk-adjusted performance over the long term, and that is determined by the market, which is why these are also considered to be passive strategies. Now, risk factors are not a free lunch because by definition, they are associated also with bearing risks, but these risks are well rewarded over the long term. So academic studies have actually shown that there are only a handful of factors that are priced by the market that provide good risk-adjusted returns, and examples of those factors are value strategies, momentum strategies, investing in smaller companies, investing in stocks with lower volatility. The other two factors are investing in highly profitable companies and also companies that tend not to over-invest, companies with a low investment theme. So that really is the important differentiation between thematic investing, is what an investor thinks will do well, and priced risk factors where the market determines that these factors provide good risk-adjusted returns.
Okay. And to stay with the factors, you mentioned value, momentum, and so forth. We often hear multi-factor investing. So what exactly is multi-factor investing, and what is better, multi-factor or single-factor investing?
Okay, so multi-factor investing is basically, it's a smart beta strategy that provides an investor with not just exposure to one of these additional factors, but to several strategies. So the factors that are priced by the market tend to be decoupled from each other. So there is a benefit to investing in a portfolio of these factors or to investing in more than one of these factors in a multi-factor index, because when one factor is performing poorly, another factor will compensate and will compensate that poor performance. In the long term, all of these factors provide good risk-adjusted return, but a multi-factor index will be able to smooth performance over the short term. So I think for retail investors, a multi-factor index is a much more suitable investment product that tends to smooth out returns over the short term and leads to good long-term risk-adjusted performance at the same time.
Okay, and you just mentioned retail investors, and so how can smart beta be used by retail, or i.e. non-professional investors?
So there are two ways that investors can use smart beta in their equity allocation. Firstly, they can use it as a core investment to replace their investment in, say, a cap-weighted index that just gives you a broad exposure to the underlying market. So it can be used as a good substitute to give you a core exposure to a particular market, but it'll provide better risk-adjusted returns over the long term. Secondly, these smart beta strategies can also be used to replace costly active managers, because these smart beta strategies provide exposure to factors that are commonly used by active managers to generate outperformance, but this exposure to factors is produced in a much more cost-effective and also consistent way. But it's important to bear in mind for retail investors that this is not a short-term strategy. It's important to remember that smart beta strategies provide good risk-adjusted returns over the long term.
Okay, well, thank you for sharing those insights, Eric.
Thank you, Dami.
So to summarize, smart beta is essentially a combination of what we think of as active and passive investing. It's active in the sense it seeks to outperform standard cap-weighted indices, but passive that its implementation is transparent and easy to replicate. Smart beta strategies can capture many themes traditionally present in active strategies, and this is well documented in academia. Hopefully this has given you a sample of what smart beta investing is about. For more information, please feel free to consult the Scientific Beta website, www.scientificbeta.com, or the website of CoreShares, which is coreshares.co.za. Thanks for watching, and goodbye.